Hey, welcome back to The Dive. Today we're chatting with Paul Andreola from SmallCap Discoveries newsletter and also director of ImmunoPrecise Antibodies. But before we bring Paul on, don't forget to hit that subscribe button so we can keep bringing you awesome content. Hey Paul, welcome to The Dive.
Hey Cass, how are you?
I'm doing all right. How about you?
Doing all right, thanks.
All right, so Paul, let's start off with ImmunoPrecise Antibodies. For our audience new to the story, can you break down the company in simple terms?
Sure. Well, first off, I'm a director of the company, and what ImmunoPrecise does is it's really sort of split up into two pieces. The sort of the revenue generating piece is what we call a CRO, or a contract research organization, and what that means is large pharmaceutical companies are now really outsourcing a large amount of their early stage research and development of new therapeutics and new drugs. And what companies like ImmunoPrecise does and other CROs is they perform a lot of those functions that traditionally would have been done by a large pharmaceutical company or biotech. So a lot of screening, a lot of development to find sort of lead candidates that a pharmaceutical company or biotech company can take into the clinic and see if they can be fortunate enough to turn it into a drug. So that's one big piece of what ImmunoPrecise does. The other piece is sort of a biotech in itself. So a lot of the expertise that the company's gained from all this early stage R&D that they've done for other companies, they've now turned it around and started to develop therapeutics and drugs themselves. So we're able to take all we've learned and build a pipeline of drugs, in the antibody space, which is a pretty rapidly growing space within the whole medical and drug space that allows the body to build its own defense system. So we're hearing a lot about that right now during COVID, but so we do both sort of revenue generating CRO business where we get paid by our large sort of pharmaceutical clients, and then we generate potential blockbuster drugs ourselves in the hopes that we can get it through FDA trials and turn it into a commercial drug.
Can you walk us through the creation of therapeutic antibodies? How expensive is this process?
So the amount varies, but the process, an antibody is a body's way of sort of building a defense mechanism to any sort of outside threat. So in the event of COVID or some of these other diseases, when you get infected with something, your body sort of mounts a defense system and creates antibodies. These antibodies go and try to either attach themselves or neutralize the virus, and hopefully defeats the virus so you get better. Not only does the body create it, but you can actually create synthetic or monoclonal antibodies that are developed out of the body. So that's what we do. We develop these defense mechanisms that can then be either injected or typically through an IV put in somebody's body, and then that defense mechanism is now there where maybe somebody who is sick doesn't have enough of that defense mechanism to fight off this disease. So that's what an antibody is. As far as the cost to produce an antibody therapeutic, it can to get it from sort of idea stage to commercial sort of FDA approval, it can take $1 billion. It's a significant amount of money to get therapeutic of this kind out there. And you're seeing a lot of developments these days in things like cancer and immune deficiency diseases, where monoclonal antibodies are, a good sort of new therapeutic as opposed to the old traditional methods of fighting these diseases.
The company just stated earnings for the fiscal year ended April 30th with $2.3 million in EBITDA on 17.9 million top line revenue. Can you speak to the growth pipeline and overall operating leverage?
Sure. So there's a couple tailwinds within sort of the medical and healthcare industry, and one of them is sort of, as I spoke to earlier, this idea that a lot of pharmaceutical companies are now really outsourcing a lot of that early stage R&D. So that sort of tailwind is exploding. There's a lot of expertise that large pharmaceutical companies actually don't have in house. So that outsourcing continues, and I think now with the massive amount of funding that you've seen going to life science companies, either through IPOs or public financings or even government funding, you're seeing a massive demand for those CRO type businesses or life science sort of service providers. So I think that bodes well for companies like IPA and other CROs. And then I think the other thing to watch for is there's the pipeline of products and therapeutics that we're developing. I think the opportunity for what's called biobuck deals or partnerships with the large pharmaceutical companies. I think the opportunity increases as the pipeline grows, and we've got a number of assets in that pipeline. So that's one thing I think investors should keep an eye on to see the potential for future growth.
Makes sense. Okay, so let's change gears here. You have developed quite a reputation on being a great stock picker with your newsletter, SmallCap Discoveries. Can you walk us through your screening process?
Sure. So we predominantly focus on Canadian listed public companies, and the way we're what's called a bottom up approach in investors. What that means is we look for individual companies and based on fundamentals. So we seldom go after trends. We really look for companies that have strong fundamentals in their own, and usually are sort of orphaned by the market. So in Canada, we use CDAR, which is the equivalent of Edgar in the US, and that's the repository for all the different public filings. So we scour through the public filings to find certain companies that meet a criteria that we've developed over time. So we like to grow or invest in high growth companies. So one of the key criteria we look for is high growth in revenues, and we distinguish it between organic and inorganic, so M&A type growth. So we focus a lot on organic growth, and we lean towards companies that are either profitable or have a clear path to profitability in the near future. So I mean, those are our key criteria, but there's a lot more things that we look for. And some of it is around sort of capital market structure, the amount of shares outstanding, insider ownership, things like that. So, real high focus on the fundamentals, leaning towards companies that have a high growth profile. And then, because we've been in the business 30 plus years, we understand a lot of the mechanics behind capital structure and ownership and things like that are important to see a successful investment.
How much thought do you put into the macro environment while evaluating small caps?
You know what? Not as much as you'd think. Again, we're bottom up approach investors, so we tend to really look for things that we get excited about as far as individual companies and their fundamentals. It's important to watch the macro, but I think it's a lot of work to follow the macro environment to pin it down in terms of what it's going to do to a small cap and micro cap company. We watch more things like capital flows in and out. We sort of try to understand what the macro might do to a sector and see how it might bleed down into a micro cap. But for the most part, we don't spend a lot of time on the macro environment.
Do you think there's a quality problem in terms of operators developing in the Canadian small cap arena?
Yes, I think I'd be careful how I say this. I'd say, there's thousands of companies in the sort of Canadian public markets. We find there's a very, very small amount that we feel comfortable investing in. And I mean, it ultimately comes down to management. So we've we've come to recognize what it takes to manage a successful microcap company, which turns out to be a successful microcap stock. And the commonalities of those characteristics, they're not that common. So, I'd say there's a very small number of companies that are being run very, very well, and those are the ones we're trying to gravitate towards. And we have to pick through a lot of companies that we're not very comfortable with to get there.
The Canadian capital markets seem to have capital flows chasing one hot sector at a time, whether it's cannabis, uranium, or psychedelics. Do you have any thoughts on where we could be heading next?
Wow. No, I mean, it's always surprises me how how these trends sort of pop up and gain momentum. It's not something I think we've ever been good at. We've been fortunate sometimes where we will find a company that we think is a strong fundamental candidate and is cheap, and then they sort of get lucky enough, and all of a sudden a trend develops around them. Um, I see there's a lot of money in the healthcare space. I think you're going to see a lot of money flow to service providers. They're able to help, the sort of the well-funded biotechs. Oil and gas has had a heck of a run. I think, it's for me, it's hard to predict trends, but it's easy to find companies that I think are undervalued. And it's shocking how often those undervalued companies turn out to be the next trend. So I'd rather focus on the cheap companies that we can find and cross our fingers that they become trendy.
How do you evaluate the capital structure of microcaps? What is the metric that matters most?
So shares outstanding, I think, are extremely important. We noticed historically that a company that's got less than sort of 30 or 40 million shares outstanding, oddly enough, tend to be stronger fundamentally than companies that have higher shares outstanding. So we like to see a smaller share structure. We like to see insiders and management own a material amount of shares in their company. We want to see they have a vested interest. Interesting enough, and I don't think enough people spend time looking at this, but we also want to see a board of directors with a significant vested interest in the company they're on the board of. So we look for those sort of things. We do a lot of work actually trying to understand the sort of the construct of the shareholder base and who owns the stock. The stronger the shareholders, typically the stronger the stock and the company. So theoretically, we like to keep the shares outstanding under about 50 million. We want to see key management own somewhere north of 10% of the company, and ideally the board have another 10%. And watch for sort of clean capital tables where there's not a lot of options and warrants outstanding. So, typical things that we like to see: small dilution. We like to see large insider ownership, and sort of low shares outstanding.
According to our research, you don't have any resource companies in your portfolio, which is where the majority of the Canadian small cap crowd focuses. What is the reason for this?
So, because I've got a lot of scars playing in that sector. So we find it very hard to wrap fundamental analysis around resource companies. I think also historically we feel that resource companies tend to do well in a sort of a raging resource bull market. So we're not very good predictors of when that's happening. And we just find it a little bit. There's more pieces to understand in resource companies. We feel to get a good understanding of what the upside could be. That's an arena where structure and really understanding who the shareholders are and sort of the promoters and things like that. Those are things that we try to de-emphasize when there's a strong fundamental argument for a stock. So resource companies just don't don't fit the criteria we typically look for.
Okay, one last question before you go, Paul. For our audience looking to sign up for your newsletter, where can they go to?
Sure, they can go to smallcapdiscoveries.com. Mention that we did this interview, and I can have them do a trial run. A lot of information there. They can certainly reach out to me if they want, but smallcapdiscoveries.com is the place to be.
Okay, great. Thanks. All right. Well, we'll talk to you next time. See you later.
Thank you. Thanks so much, Cassandra. Bye now.
To our audience at home, thanks so much for tuning in. We'll be back again tomorrow, so be sure to stay tuned. And why don't you check out that video while we're here?